Well, let's get across the market open now for this Monday. Kyle Rodder joining us from capital.com. Kyle, great to catch up with you. Let's start what we saw in the US on Friday. Quite a bit of data, certainly jobs-wise, to get across. What did you see?
Yeah, probably a bit of a mixed print to some extent, but overall, I think the market's interpreted it as a bit of a signal of a continued strength in the US labour market, especially when you looked at the drop in the unemployment rate to 4%, and then also, some fairly resilient average hourly earnings. Perhaps the most noteworthy detail, though, was that we did get the annual revision to that to the year's non-farm payrolls figures, and while the kind of preliminary number that we got back in August was suggestive of, perhaps job creation being around 900,000 jobs weaker than what the official data had conveyed. The final figure was closer to sort of 500,000 to 600,000, suggesting that, while there was that downward revision, certainly we're seeing, what was a very, very strong labour market throughout the previous 12 months. So, I mean, effectively, we've got markets now by virtue of that, as well as some fairly concerning, one might say, inflation expectations figures in the University of Michigan Consumer Sentiment Survey, which showed a really, really big jump in that kind of gauge, mostly because of tariffs. That's deferred the timeline for that first interest rate cut from the Fed from around the middle of the year to closer to September now. That's the first meeting that we see a cut fully priced in. And once more, there doesn't seem to be any real impetus in the short term for the Fed to cut interest rates. The labour market's solid, and as we'll get an update on this week, we're likely to see that inflation, while fairly moderate and not accelerating, is still sticky around that kind of 3%, give or take.
Yeah, speaking of those inflation expectations, they would only have exacerbated, you would have thought, in the wake of what Donald Trump had to say on Friday, warning that his further reciprocal tariffs are afoot. He didn't name any countries, though, but obviously that has concerned the market.
Yeah, and I mean, that was the story behind inflation expectations. And, we had Scott Bessent, for example, coming out last week talking about the inflationary risks of tariffs. And, the consensus view is that, if we see them even applied at their worst or their highest rate, it's a one-off price shock, which obviously complicates things for the US Federal Reserve, because they'll have to look through that and maybe delay any interest rate cuts because of the impact of tariffs. But ultimately, it sort of, in the long run, becomes more of a drag on growth because, again, it's not a constant change in the rate of inflation or a consistent increase in the rate of inflation. It's that kind of change in price levels. The counter argument to that is if tariffs start to impact the expectations channel with consumers, and that kind of leads to that vicious cycle of potentially higher price rises going forward, or it's certainly at least inflation that doesn't continue to moderate because of these expectations that tariffs will continue to be applied, and that kind of sets off again that sort of vicious cycle. So that was a big part of the reason why markets were so jittery on Friday, was that sort of data to suggest that indeed that is starting to manifest in the inflation expectations channel. And then on top of that too is that we had fresh threats that there would be another announcement this week of reciprocal tariffs, and then maybe more tariffs on other trading partners. And if you look at this morning, some of the price action, we're already seeing the euro drop marginally. The European Union has gotten on the front foot effectively and cut auto tariffs to try and sort of curry favour with the Trump administration. There was also comments from US President Trump about potentially trying to fix, so to speak, the trade deficit with Japan, which also speaks to the fact that maybe the Japanese economy may be confronting the risk of tariffs going forward as well. So, it's a truism or was a truism in the first Trump administration that you kind of, lighten up on risk potentially going into weekends, because he had this kind of tendency to make these announcements going into the weekend or over the weekend, especially as it applied to sort of trade and tariffs and what have you. And once again, like we saw a week ago, some, conversation, not sort of any actions this time, but certainly some rhetoric about tariffs going forward have sort of sparked a bit of a sell-off into the close on a Friday, and setting up Asia now for a fairly weak open, it has to be said, this morning.
Now, data-wise, Kyle, the focus this week in the US is going to be on inflation data with both consumer and producer prices. What are the expectations there? Interesting. I mean, the market has essentially priced out any chance of a rate cut in the next meeting, looking at a roughly 55% chance of a cut by June.
Yeah, exactly. And, it was only about a week or so ago that after some, okay developments on the PCE front, as well as some sort of softer than expected data in the ISM surveys, or at least the services surveys, and some of those jobs figures we got in midweek June was sort of, the meeting that was almost fully priced in for a cut. It's now being pushed back to September. So again, zooming out, the Fed doesn't really have that much impetus at the moment to cut interest rates. On the one hand, inflation's sticky, but on the other as well, if you look at the labour side of the mandate, or the full employment side of the mandate, clearly the US labour market is running close to, or maybe even beyond any sort of notional level of full employment. And really, we're going to have to see fairly significant further progress on inflation going forward, despite some fairly significant inflationary tailwinds in the US economy at the moment, to sort of see the Fed pivot at all, and certainly the market revising those expectations for interest rate cuts going forward. So this data this week is probably going to show that inflation remains around 3%. Not terrible, but by any means. But again, it's just that progress that is very, very slow. So should that happen, again, it just adds weight to adds weight to the argument that the Fed won't need to cut anytime soon. It has to be said, equity markets are pretty comfortable with that. We're still seeing, broadly speaking, and taking tariffs out of the equation, or trade wars out of the equation, markets fairly happy to rally on the basis that the US economy remains strong. But still, those expectations of rate cuts in those areas of the market that might be sensitive to monetary policy is unlikely to get any sort of reprieve anytime soon with what we know about fundamentals, and it would probably be the case in the balance of probabilities. This inflation print will sort of lend itself to that this week.
Meanwhile, locally, not a lot of data to consider this week, other than we've got to read on consumer confidence tomorrow for the month, but really the focus being on earnings.
Yeah, definitely. And I mean, if we were to sort of frame the earnings period at a very kind of broad level, the concern here is valuations, like it is everywhere across the world at the moment, but probably more sensitive or more pertinent it is to the ASX 300, really on the basis that we're not seeing that strong earnings growth in Australia, and that the really key areas of the market which might be able to sort of justify potential earnings growth, as far as obviously the compositional factors here we're talking about, the banks and the miners are both facing their fairly significant headwinds because of a sluggish Chinese recovery, and then also because of fairly weak domestic economic activity, some of which is being, or the future, the outlook of which is being a little bit supported by the prospect of a rate cut coming in a couple of weeks' time. But I mean, the CBA is going to be absolutely crucial, because it's really been pretty much a great barometer, as well as the exemplar of a company whose stock is trading, not because of its fundamentals, probably because of retail trader investment interest and momentum, as well as passive flows going into the Australian market, as broader global equity market sentiment remains relatively robust. And we've got the bank trading at a 28 to 1 PE multiple, despite the fact that earnings growth is basically flat, is expected to remain so over the next few quarters. So, it could be really, really interesting with some of these companies reporting this week, and really add perhaps some level of, domestically driven volatility, because again, we've got a market at record highs with very, very high multiples, some stocks that are really, really richly valued. And again, the company fundamentals don't seem to be justifying them, at least with what we can tell right now. So hugely influential, and arguably the first time in a few months that we're going to be able to actually look at domestic fundamentals to try and get a sense of where risk should be priced in the ASX 200, because up until this point, obviously, it's been very much a global macro story, or a trade war story, China story, or what have you.